Hey, this is Larry Gonzalez, and yes, this is Larry Gonzalez, and I've lost my hair. I'm going camping next week in Alaska with my Boy Scout troop, and so I don't feel like dealing with hair out there. So no hair, it'll slow me down if I was trying to escape from the bears. So here you go. So you get Larry with short hair today. All right, so let's get into what you really care about, and that is the housing market and what's going on. Let me tell you, this has been a crazy week when it comes to things that affect the housing market. But let's go back to the three basics. Prices are going up. Inventory is still down from where it should be. And here's the other thing. In 1 month, typically inventory starts to go down because people have already put their houses on the market, but we haven't really seen that increase yet. So inventory is still below where it should be, below where we need it in this market. And then rates are up and down, and when the Fed made their decision, we'll get into that in a little bit. You would think the inflation reports, and we'll get into that in a second, coming down, showing inflation coming down, the Fed not raising the Fed funds rate, that you think interest rates would come down. No, it talk about a roller coaster ride. As a matter of fact, on Wednesday they started the day down, then they went up, then they went down, and then they came back up. We basically ended the day where we started. So not a lot of movement, and we'll get into some of these reports right now. We're right back where we were really at the beginning of the week. The first report that came out this week was on Tuesday, and that was the Consumer Price Index. And the Consumer Price Index, that is a cost of goods and services to you and me, the regular Joes and Joannas of the world. And two parts. There's the overall inflation report, and then the core. The core strips out the food and energy, because food and energy is typically more volatile. And the first one was really good, actually. Month over month actually was down 0.1% lower than what was estimated. And overall inflation, as you look on the chart, dropped from 4.9% in April down to 4%. That's great news. But you know what? The Fed doesn't use that as their measure of inflation that they're looking at for that 2%. They're looking at core. And the core, while the core went down from 5.5 to 5.3, that wasn't really enough to move the needle. It was kind of in line with estimates. So really, interest rates didn't go down as much as they could have and they should have. The big reason why the core rate didn't go down, and let's look at this chart. I want you to look at this chart. We're at 6% was the core rate, and we have not gotten below. We have been in the 6 to 6.5 down to now 5.3 range, but we haven't gotten below the 5% range, and we're kind of stuck. And as long as that core inflation is stuck in this range, I don't think we're going to see appreciable movement down in interest rates. Now, I'll get into what the Fed said today, but keep in mind, we are stuck in this range between 6 and 5% right now on the core rate of inflation measured by through the CPI. So we are stubbornly in that range. Why are these prices staying up? Well, there's two big reasons. One of them is shelter. Shelter costs haven't come down enough such that between last year and this year, they haven't come down enough to really get us lower. And that's the shelter cost is the biggest piece of the core reading now. And the second, used car prices. Used car prices actually were one of the main reasons why the core inflation didn't really come down anymore. And that is the cost of used cars and also car insurance. Because that is a cost to the consumer. Those two reasons, shelter and autos, particularly used autos, are the main reason right now why the core rate isn't going below 5%. I think once you get that core rate below 5%, then you're going to see interest rates start to come down and maybe stay down a little bit longer. Instead of being in a range between 6 and 7% for interest rates, maybe we'll see 5.5 to 6.5%, which is much more amenable to all of us who are looking to buy homes and certainly sell homes. So, and the last thing on the CPI I want to point out is last year we were at 9% for our CPI reading. We're at 4%. That is, core is stubborn, but overall inflation is coming down, and that is a good thing for the consumer. Now let's look at the next report that came out. That came out on Wednesday, same day that the Fed made their announcement. So PPI is the producer price index. So that's the wholesale cost to wholesalers, people who sell and goods and provide services. So it was actually down 0.3% in May. The expectation was 0.1%, and it dropped. It dropped from 2.3% down to 1.1%, which is amazing. And actually, it's the lowest we've had since December of 2020. And pretty soon, I'd say within the next couple months, you can fully expect us to be a negative producer price index. And we haven't been there since 2020, really mid-2020. So what does that mean? Well, that is when the cost for producers goes down, so ultimately does the cost for the consumers, because the producers provide to the consumers. So that is a good thing. And if you look at this chart, our peak last March 2022 was 11.7%. So in a matter of 14 months, we've gone from 11.7 down to 1.1, almost a 10 percentage point drop in the producer price index. Now let's go to the core, which strips out food and energy. Well, that went from 3.2% down to 2.8%. So a little better than what was expected at 2.9%, but still not really moving the needle enough to say, hey, inflation's going down. Now, the Fed is not looking at core PPI, they're looking at core CPI. Actually, they're looking at the PCE, which we'll get in a couple weeks. And the reason why the core hasn't gone down is because of autos. It's not only the used autos, the cost for the wholesalers for used autos, but also for the parts to repair those used autos. So interesting on that. But PPI, producer price index, is going down. We should be negative here. And if you recall, inflation was at 2% at the beginning of 2020. All right, and that's when producer price index went above zero. So there is a relation. One doesn't cause the other, but it is interesting to note we're going to get down into the negative here soon. And then let's get into the Fed, because the Fed met on Wednesday. And the Fed, they did not raise the Fed funds rate. And that was fully expected. Now, are they going to stop raising the Fed funds rate is a big question. And the answer from the Fed is probably not. They fully expect, right now we're between 5 and 5.25% on the Fed funds rate. Expectation is at the end of the year, they'll be at 5.6%. So that's a possibility of 2 more rate hikes. So they didn't necessarily skip a rate hike, they're holding. They're holding to let basically the dust settle. And then in the next July meeting, there's a really good chance, unless we get a couple good inflation reports come out and unemployment reports go up, there's a good chance that they're going to raise the Fed funds rate again. So, and again, go back to what I just showed you. That stubborn the core CPI, we're stuck above 5%. We need to get below that. The Fed chair talks after they make their announcement. He had a lot of things to say. One, he predicted at least 1 to 2 more hikes this year. And this is a big deal, guys. All right, the last 10 meetings, they raised the Fed funds rate. This is the first one in over a year that they haven't raised the Fed funds rate. That's pretty big. And that shows a little bit of, I think, common sense by the Fed. They're not going overboard. They want to let the dust settle. They want to see if inflation is indeed going to come down. And there's some time lag in the reports that they're using to make this determination. All right, shelter costs. There's a 12 to 18 month lag on shelter costs. And autos, maybe a couple months lag on the true cost of autos. And those are a couple of the reasons why the core rate of inflation is up. But very important to note, they are holding. They are not pausing. They fully expect to raise the Fed funds rate at least twice, 1 to 2 more times a year. A couple other things they talked about. Again, their goal is to get core inflation down to 2%. They think that by the end of the year, we'll be at 3.9%, at end of 2024 at 2.6%, and then somewhere in 2025, we'll be at 2%. So based on that, you can expect that the Fed funds rate will remain elevated until 2025. And then the other thing, unemployment. They've been saying they want to see unemployment up to 4.5%. Here, to me, is a big one. They have brought that number down to 4.1%. Why? Because there's so many job opportunities out there. and so few people to take these jobs. Almost 10 million job openings and 1.8 million who are unemployed. There's a big delta there. 4.5% unemployment is not realistic. 4.1%, maybe. Remember, this last jobs report that came out last week, unemployment went from 3.4% to 3.7%. So unemployment is going up. Their goal is 4.1%. And I think once they see that as well as inflation definitively going down, once they see inflation definitively going down and unemployment going up, once the Fed sees that, then they will turn that hold to a pause. Not realistic for them to lower the Fed funds rate before the end of the year, just because you look at that, just go back to that, the consumer price index. Really, for the last year, that core inflation has really been sticky. So what does this mean for housing? Well, great question. And for people who are buying, know that rates, they're going to stay higher. I wish they were going to be in the fours. They're probably not going to be in the fours this year, probably not next year. We should get into the fives here, I would say, in the next couple months. But again, it depends. There's a lot of other things. The key is, despite wherever interest rates are, home prices are still going up because there's such a low inventory. And if you can get into a house now, if you can be fortunate enough to get a seller credit to do a buy down, what you're buying, in addition to a lower payment, is time for those interest rates, for inflation to come down and then interest rates to fall. If you're a seller, I still think it's a good time to sell, especially on the mainland, because I'm not really seeing too many seller credits right now. So that people are getting the prices they're asking on homes. So that's really all I got for you guys. A lot of stuff going on. And if you have any questions, please don't hesitate to reach out, like, comment, subscribe, PM me, DM me, whatever. Love to hear from you. Have a great day. All right. And next week, this report will come from Alaska, if I have service and I'm not being chased by a bear. All right. Aloha. And remember, don't give up the ship.